Peace and blessings, everybody. It is your girl Shay Marie back for another video. The name of this video is titled "You Are the Lender, the Banks Are the Borrowers." That's right, you guys. You are the lenders, the banks are the borrowers. You guys, I'm bringing you this video today because it has definitely been on my heart and my mind for quite some time. I've been trying to figure it out, put the pieces of the puzzles together for us, because we all been wondering why even still today in this great, supposed to be great country, although we know it's not great right now because we're going through this crazy pandemic and the riots and everything that are going on, and all of this political war, spiritual war. We know all of these things are going on. But before these things happen, we were all wondering, why, what is actually stopping the progress of the world? Why is there so much poverty? Why is there so many hungry children all over the world? Why are there homeless people out on the street? Why? What is the purpose, you guys? And so today I'm here because I want to bring to you a piece of the puzzle. It's not a whole piece, you guys, but it's a huge piece that of the puzzle that plays a major part, because you guys, we play a part in this as well. And I don't think a lot of us know what has been going on, because we like our the great Malcolm X said long before, back in the 1950s and 60s. He said, "You've been cooned. We've been hoodwinked. We've been bamboozled, led astray, and run amok of, you guys." And he is absolutely right. And so we're going to talk about it today. As I said, I am your girl Shay Marie, and as you can see here, I have this picture up for a reason, because I have to defy the odds, you guys. I have to defy the odds. If it's to be, it's up to me. I care about my people. I can't just keep allowing things to go on and this way. It allows people to believe that, just some imaginable being is going to fall out of the sky and we're all going to be saved and things like that, you guys. I have to let you know today that your freedom, you guys, it's up to you. If it's to be, it's up to you. You have to take action. But in order for you to take action, you guys, you have to know exactly the problem so that you can begin to find the solution. And I have the problem and the solutions for you, but we're going to talk about it. So let's get to it. So we're going to talk about fractional reserve lending and fractional reserve banking. We're going to talk about an overview. I'm going to just be giving you a very quick overview today of what fractional reserve lending and fractional reserve banking is. As you can see here in this diagram, it pretty much works this way, but we're going to take a deeper dive into it. So the concept is based on the fact that people deposit more money into the bank than they withdraw. So let's say you put $10,000 in your bank account today, right? The bank only needs to keep a portion of that in the reserves. So they only need to keep a portion of that. So 9 times out of the 10, they're going to only keep about 10% of that 10,000, or 1%. Let's keep reading. Because most people aren't withdrawing their entire savings, the bank will always be able to pay withdrawals with their total reserve stockpile. And I posted an article on my Facebook today, which we're definitely going to talk about, but it talked about how the Federal Reserve cut the requirement for banks to have to zero, meaning banks do not need to have any reserves at all in the bank, you guys. They don't need to have any reserves anymore in the bank. So you're probably asking, what do they do with the other 90% of the cash? Well, as you can see here, you guys, they loan it out. They They market people to come and get loans, and they credit card loans, all type of loans, and this is basically what's going on. So let's talk about it. The way that they can make all the money on the interest is from the loans, is how the bank works. And this is just a little illustration to show you. Oh, I can't blow it up for some reason. I apologize. But let's continue reading. If they couldn't loan out any of our money, they wouldn't be able to make money, you guys. When you deposit your money into a bank, just as you see here on the screen, you are actually loaning to them, and they pay you a super tiny, negligible bits of interest. It's not even really enough to really talk about compared to what they're making, you guys. And I'm gonna show you very quickly in a short while what I'm talking about. They are literally in business of borrowing your money in order to loan it to someone else. The only reason we feel good because they keep our money safe, but we aren't necessarily getting a great deal, you guys. And Benjamin Franklin said it best: he who will trade liberty for some temporary security deserves neither liberty nor security, you guys. And this is why we've been getting our ass whooped for a long time financially, you guys. And excuse my French, but I just had to say it. After all, they need us just as much as we need them, but that isn't being reflected in the deal terms. And this is pretty much what we're doing, you guys. You know, wait a minute, something feels wrong. And then you got a million more of them saying, shut up, you moron. Do as you've been told. It's for your own good. And this is what we've been doing for quite some time, you guys. We've just been doing as we've been told, and we have not been asking questions. And this is why we are in the predicament that we're in. Let's keep reading. For one thing, at any given moment, the bank could be spending your money on something you didn't even agree with. You'll never know about it, and you never got the choice to say if you wanted to loan the money, which is because as long as the bank can give you money from someone else's reserve, you never miss it. So all this time, you guys, our money has been in the bank. We put our money in the bank, and they can just give us money because we think our money is sitting in there. But no, our money is not sitting in the bank. All of they're doing is just handing us someone else's Federal Reserve notes, you guys. So let's talk about it. Let's keep on going here. As long as you can take your money whenever you need, the system works, right? Well, that's not quite what it is, you guys. So we're going to find out how normal banking works. To explain the enormous problem caused by fractional reserve banking, let me tell you how banking works without it. At any bank, an individual can make one of two types of deposits. One deposit is on-demand deposits, which I consider checking accounts. As you can see, they have a checkbook. Accounts at financial institutions that pay no interest and on which depositories can write checks to obtain their deposits at any time. So there you go, a checking account, right? So let's keep reading. So let's say you put $10,000 into a bank account. You want to be able to access that money whenever you need it. That's pretty much what the on-demand bank account or deposit is. And then you have a time deposit, which on the other hand is an investment. You invest in the bank for several months. I'm sorry, I have a misspelling here. Several months or years, intending to get a higher return when your money comes back. So that's pretty much a savings account, right? Or some call it term deposits, right? depositors are often prefer term deposits because they pay more interest than traditional savings accounts, yet are just as safe. So that's another form of a time account, you guys, or a time deposit. So let's keep reading. Without fractional reserve banking, the only money a bank could use for loans would be time deposits with fractional reserve banking. The bank can use all the time deposits and roughly 90% of the demand deposits, subject to fluctuating government mandated reserve requirements. So what's the problem, you probably asking? You probably like, Shay, okay, what's the problem? If you haven't seen the problem already, then let's keep on reading, okay? First off, the banks only make money based off of your deposits, and you get hopefully 1% interest on your deposits if you're lucky, because we're in 2020 right now, and let's face it, banks are probably giving less than 1% right now on savings accounts, and so to me, I see that as robbery, you guys. I don't know about you, but I just see that just as bad as robbery is. What do you guys think? Leave a comment for me in the description and let me know what you think about that. But we've been stuck up for a long time, getting robbed blind right before our eyes while the banks live off of our hard-earned money like fat rats. They make me so angry every time I think about it, you guys. I'm sorry, I just had to type that in there, but it does make me angry every single time. But that's not all, you guys. The person borrowing your money via the bank's credit card has to pay 25% APR on the money they borrow. The banks is keeping 24%, and they net that as their profit. So they're charging 25% interest on the money that you've put in the bank that they've loaned out to someone else that you don't even know, right? In the form of a credit card or a loan, a personal loan, however you want to call it. They've loaned out this money, they've loaned it out, and they've been getting paid 25% interest. You've only been earning 1% interest, you guys. Is this fair? Do you believe that this is a fair banking system? I mean, do you really trust these people? Let's keep reading. But if it wasn't for customer deposits and customer deposits, I'm sorry, I got that twice, they wouldn't be able to loan any money or have a business, for Christ's sakes. They wouldn't even have a business if it wasn't for us, you guys. So why aren't we getting at least 10% of that interest, or at least 15% of that interest that they've earned in those loans? The whole retail banking model takes advantage of the average consumer by not paying depositors a bigger fair share of interest earned, you guys. Further, although both demand deposits and time deposits are similar, they affect the total world economy in completely different ways because of interest rates set by the Feds, you guys. Fractional reserve banking, on the other hand, consists of artificially low interest rates. This is because of the practice of fractional reserve banking. Banking is actually creating money. Dig this, you guys. I have to edit this. It's actually creating money out of thin air. So let's say you deposited $10,000 into the bank again, right? This is you depositing $10,000 into the bank. So the bank then loans out $9,000 of those $10,000, you guys, while still showing you in your bank account that you have $10,000. $10,000. So they're still showing you that you have $10,000 in your bank account, although they've loaned out $9,000 of your money, you guys. This is insane, right? Basically, what they've done is created $9,000, 9,000 new dollars from scratch and injected it into the economy. So now they're making money off of your money and the fake money they created out of thin air, and all they are willing to give you for you being so kind. I'm sorry, you guys. I was typing this so fast that I had to get it up on here and make this video. But they've been created out of thin air, and they are not willing to give you anything. They give you 1% for being so kind and gracious to allow them to lend out your money to other people. This is why I'm telling you guys, you are the lenders. The banks are the borrowers, and they've been robbing from you, you guys. They've been robbing from you. I don't deal with the traditional banks. I deal with the deposit accounts, or the the on-demand deposit side of things. But as far as the time deposits, I don't deal with, you guys. I'm just sorry. So let's keep reading. Commercial banks can also get loans from the Federal Reserve, the U.S. Central Bank, and again only needs to keep a fractional reserve. And as I just told you, now they don't even need to have any money on the books. They don't need to have anything in reserve at all to be able to lend out money, you guys. So the money that you're putting in the bank is not there. There is no money, you guys. I gotta let you know this. Because interest rates are artificially lowered and not based on free market principles of supply and demand, there is no distortion in the real economy. Low interest rates incentivize businesses to take more risky and potential unsustainable investments. At the same time, the price of goods goes up. So this is just a little depiction of how over time, you guys, the price of goods have went up because of this very system that you see here. So back in 1998, you see $20 was able to get you a full basket of groceries. In 2005, you maybe were able to get maybe like half of a basket. And today, you guys, you really don't need this full basket, right? You pretty much can carry everything you need for $20 in your hand, or get one of those little small baskets. I apologize about that. So let's keep going. Inflation is the price of goods and services. The prices of goods and services are rising. The value of the currency decreasing. So the prices are rising, the value of the currency decreasing, because they've inflated the market with paper, with fake thin air money, you guys. This is what's going on. Overall, because more cheap money is available. So now we're going to talk about the stimulus real quick. Let's talk about this stimulus, Corona, and all of this riot crap that's going on very quickly, and how this relates. Stimulus packages is a related concept in the business cycle, where the government step in and stimulate national economic growth and activity. These are typically emergency bailouts to save industry littered with malinvestments. It is only natural that some of those investments don't pan. The investment turns into a malinvestment, becoming completely worthless. For example, an investment bank might buy equity in a software startup. That startup uses the money they just raised to pay salaries, conduct research and development, spends on big marketing, etc. If the start of the business goes bust, the investors lose their money, right? In times of hard money as opposed to easy money, investors are less risky with their hard of income, hard to come by cash, and are forced to do deeper diligence and make sounder investments. The vacillation between spending investments, easy credit and lower interest rates versus saving, hard credit, and high interest rates is known as the debt cycle or the business cycle. And so we're just going to stop right there. This pretty much finishes up my video today about the Federal Reserve lending, and I just wanted to let you guys know how you are the lender and not the borrower. The banks are the borrowers, you guys. And if you enjoyed this video, if you like this video, you guys, please give me a thumbs up and subscribe to my channel, you guys, because I'm going to be bringing you more information like this. We're going to be putting the pieces together. On the next video, we will be talking about quantitative easing and how quantitative easing works, so that you can get a better understanding about what's going on in the financial world and in politics, and why we are actually in the times that we are in today. So I will see you guys on my next video, and we will discuss this further. I just had to let you know, guys, know that you are the lender. The banks are the borrowers. It's your girl Shay Marie, and I'll see you guys on my next video.